Good morning from ORTEX. Today is Friday, June 10th, and these are your data highlights. Both DocuSign and Stitch Fix, which we covered in yesterday's data highlights, reported disappointing results yesterday evening that led to both stocks cratering in after hours. DocuSign's results were mixed relative to expectations, beating on the top line but missing on the bottom line. Most importantly, the electronic signature specialist cut its billings guidance for the current fiscal year. Billings for the year are now forecast in the range of $2.52 billion to $2.54 billion, down from the prior outlook of $2.71 billion to $2.73 billion. The revision confirms investor fears that growth is slowing as many markets return to normalcy. DocuSign's growth has been supercharged throughout the pandemic as businesses turn to the company's services to maintain productivity. DocuSign's net dollar retention rate fell to 114%, the lowest level in over 2 years, as customers are not increasing spending as much as they were previously. ORTEX analyst data shows one analyst from Evercore ISI Group has downgraded their recommendation from a buy to a hold. Stitch Fix also sold off by 16% following its release. Revenue fell 8% to $492.9 million, and active clients decreased by approximately 200,000 to 3.9 million. The company has been scrutinizing its cost structure in recent quarters, acknowledging that its marketing spend has been inefficient. Stitch Fix said that it plans to lay off approximately 15% of salaried employees, which will result in a total workforce reduction of around 4%. The cuts are expected to deliver $40 million to $60 million in annual cost savings, with another $15 to $20 million in associated restructuring charges. Bears will cheer the gloomy news as short interest is 15 million shares, or 21% of free float. Make sure to subscribe and come back every weekday for interesting data highlights from ORTEX.